Welcome to the panel session on the future of finance. My name is Ajay, Patel, and it's my pleasure to be moderating this session that includes two very well-known individuals in their respective fields. To provide some background on the session, we know that the financial crisis is in our rearview mirror, but its effects continue to linger on. We're still trying to sort out what should have been done in response to the crisis, and we continue to sort through what should be done now to prevent a repeat. This session, featuring two of the leading voices in practice and academia, will address what the future holds for finance and the profession of finance. What has changed? What should change? What is the way forward given what we know about the financial crisis, its causes, and its aftermath? Our first panelist is Franklin Allen. I'd be surprised if anyone in this room doesn't already know Franklin, but just in case I am wrong, Franklin is the Nippon Life Professor of Finance and Economics in the Finance Department at the Wharton School of the University of Pennsylvania. He's been there since 1980, which is when he completed his doctorate at the University of Oxford. He also received an MPhil from the University of Oxford in '79 and a BA from the University of East Anglia in '77. Franklin has been the president of the American Finance Association and more recently the president of the Financial Management Association. We are all aware of how prolific and impactful a scholar he is, but I wonder if you know how impactful a teacher he happens to be as well. Between 1990 and 2002, Franklin has won 23 teaching awards from the graduate division, the undergraduate division, and the MBA core program at the Wharton School. Just to repeat, that's 23 teaching awards in 13 years. Quite an impressive feat, Franklin. Very soon he's going to be moving to head Imperial College's Brevard Howard Center for Financial Analysis. The new center, to be based in the Imperial College Business School, will be headed by Professors Franklin Allen and Douglas Gale. Frequent collaborators, Professors Allen and Gale are renowned for their pioneering work into financial crises and market contagion. Our second panelist is Nitin Mehta. Nitin is the managing director of the CFA Institute, where he oversees operations in Europe, the Middle East, and Africa. He joined the CFA Institute in 2006. For almost a decade before, he served as head of international equities at Henderson Global Investors, a UK-based fund manager with institutional and retail clients. At Henderson, Mr. Mehta was responsible for managing investments and equity teams covering Europe, the United States, Asia, and emerging markets, as well as technology and socially responsible investing. Earlier in his career, Mr. Mehta held a variety of positions of senior responsibility at investment firms, including Quorum Capital Management, a London-based subsidiary of New York Life, where he was head of currency and derivatives, and Shearson Lehman Global Asset Management in London, where he was head of global equities. Mr. Mehta is a CFA charter holder. He earned an MBA from the London Business School in '86 and a bachelor's degree in computer science from the University of Manchester Institute of Science and Technology. Let's turn to the crisis now. In 2007, the housing crisis worsened. Banks and hedge funds that invested heavily in subprime mortgages were left holding assets whose value had declined substantially. Freddie Mac, in February of 2007, stated that they would no longer purchase the most risky subprime loans. In April, New Century Financial, a subprime mortgage lender, filed for bankruptcy court protection. In August, American Home Mortgage Investment, which specialized in adjustable rate mortgages, filed for bankruptcy protection. In 2008, the US economy was in recession and the subprime mortgage crisis infected the credit markets. In January of 2008, Bank of America agreed to purchase Countrywide Financial for about $4 billion. In March, the Federal Reserve agreed to guarantee $30 billion of Bear Stearns assets in connection with the government-sponsored sale of the investment bank to JP Morgan Chase. In July, EMEA Federal Bank became the largest regulated thrift to fail. By September, mortgage giants Freddie and Fannie were taken over by the government. On September 15th, Bank of America agreed to purchase Merrill Lynch for $50 billion. On that day, Lehman Brothers filed for bankruptcy court protection. On the 16th, AIG accepted an $85 billion federal bailout that gave the government a 79.9% stake in the company. On the 21st, Goldman and Morgan filed to become bank holding companies. On the 25th, federal regulators closed WAMU, and its branches and assets were sold to JP Morgan Chase. On October 3rd, Congress passed a revised version of TARP, and Wells Fargo agreed to acquire Wachovia for about $14.8 billion. On November 22nd, Citigroup was rescued with a package of guarantees, funding access, and capital. Citi issued preferred shares to Treasury and FDIC in exchange for protection against losses on a $30 billion pool of commercial and residential securities. And then on December 19th, the U.S. Treasury authorized loans of up to $13.4 billion for GM and $4 billion for Chrysler. All of us can recall these events that I just mentioned that occurred in 2007 and 2008. We're also aware of the many reasons given for these events. Individuals were said to have been over-leveraged, with the greatest leverage or increase in leverage occurring for middle-income borrowers. Over-eager lenders and financial institutions chasing yield added to the problem. Governments, central banks, regulators, and legislators played a role by keeping interest rates low, by allowing leverage to increase dramatically, by allowing government-sponsored enterprises to operate at inadequate levels of capitalization, and by exempting OTC derivatives from regulation. The rating agencies played an important role in facilitating the leverage boom, and to some extent, non-financial businesses saw their leverage increase as well. So, we seem to have some sense of why the crisis happened, but we are very aware of the events as they unfolded. So this seems to be an opportune time now to turn to what we have learned from the crisis, what has changed, what should change, and what the future holds for finance and the financing profession. And to turn to these events, I've asked each of the panelists to speak for up to 25 minutes, following which we will open the floor for questions from the audience. We do have a mic here just to make sure that people in the back can get heard, so when you do have questions, please use the mic and we'll pass that around. And Franklin, let's start with you.
Thank you, Ajay. I'd also like to thank Jack and the FMA for organising this session, because I think it's an extremely important topic, and I think in finance we don't quite realise how much ordinary people doubt what we do and the possible effects of that. If you pick up the newspapers, pretty much every day there's some revelation of some wrongdoing in the industry. And not surprisingly, people are very skeptical that we do anything that's particularly worthwhile. But I think it's important that we don't lose sight of the fact that finance has got a tremendous contribution to make to society. If you're going to make people better off, if you're going to, in poor countries, lift people out of poverty, in rich countries you're going to share risks and improve productive capabilities and so on, you're going to need finance. And not just in the narrow sense of providing money to buy these things, but of course one of the things that we do in finance is think about investment decisions and how we should decide which things to do and which things should not be done. Finance plays a role in the private sector, clearly, and it plays a role in the public sector. And it also, importantly, plays a role in the non-profit sector. And what I want to do to start with is to look at some examples of some of the positive things that finance has to contribute. Because when we then look at some of the less positive, the dark side of finance, I think that there is a real danger that those attempts to rule out the dark side will also end up ruling out the positive side. I think you can argue that in any country that that's what happened after the 1930s. If you look to the 1940s and 50s after the Second World War, particularly in Europe, many countries regulated the financial system to an extraordinary extent and repressed it. Governments made financial decisions about which industries would get funds and which industries wouldn't. And it took a long time before people realized, well, that's okay after the war when we have some basic idea that we need a steel industry, we need an auto industry, and so on. But by the time we get to the 1960s and 1970s, governments didn't do a very good job in terms of the decisions they made about what should be funded and what shouldn't. And then we had the big move towards privatization in the financial sector. So let me talk about one of the areas which I think is extraordinarily important, which is private equity. And venture capital in particular plays a very important role in my view. Now, it took a long time to find out how to do that. So in the US, they started out just after the Second World War with ARD. And initially, they did it as a closed-end mutual fund. And one of the problems with closed-end mutual funds is that they come under the 1940 Investment Act, and it's very difficult to give high-powered incentives in that environment. So you can't actually reward people as a percentage of the profits that they make. You have to do it as an asset value. The exception is if you have what's known as a fulcrum fee, where you actually have losses. So if there are losses, you have to actually give up money when there are losses in order to make a proportion of the profits. Now, by the time the 1970s had arrived, people had sort of realized that they didn't get very good managers in these kinds of venture capital funds. And they started setting them up as limited partnerships in order to enable high-powered incentives to be used. The other big move was that the ERISA reforms allowed pension funds and other institutional investors to invest in these kinds of entities. Before, it had been regarded under the prudent man rule that you couldn't do that. There's a very nice paper by Josh Lerner and Peter Tofano who look at venture capital. And what you find is that venture capital-backed firms are important in the sense that they make up about 13% by number, but 8.4% by value of publicly listed firms. But in high-tech industries, it's much, much higher. So in software, it's 75% by value. There's a whole range of evidence that venture capital leads to innovation, and I won't go through the details, but it seems that it is synonymous with innovation. And I think if you look at some of the firms that venture capital started out by backing, they're the companies which are at the top of the stock market in terms of market cap. So Apple was the most valuable company for some time, the last few years. Cisco, Facebook, Genentech, Google, Microsoft, Intel, these are all amazing companies that have transformed the way that we live. And one of the things that I think is very interesting is that these kinds of companies are mostly in the US where VC plays this role. And one of the things that is striking is there don't seem to be quite the same level of firms that do completely new things, either in Europe or in Asia, in the last 30 or 40 years. And I think a lot of that has got to do with the role of venture capital. Now, of course, as an industry, actually, venture capital is a very small segment if you look at funds loaned. But it's a very important segment in terms of setting up these firms that then grow, that then start employing large numbers of people and become extremely important. So it's like the apple seeds or the seeds of oaks, the acorns. It's really crucial in my view. Once they started developing venture capital, people realized that this kind of limited partnership with very high-powered incentives could be used for leveraged buyout funds. And what we saw in the 1980s was, to a large extent, the restructuring of traditional industries by leveraged buyout funds. And again, there's a lot of evidence that these funds do good things in social terms. So they often criticized, particularly earlier on, that they led to high bankruptcy rates because they took companies that were public, private, and then they made them public again. And the notion was that these companies soon went bankrupt because they had too much debt or they didn't invest enough and so on. And in fact, there's a fair array of evidence now that that's not the case. So, for example, Per Stromberg showed very nicely that firms that have been taken out by LBO firms, the bankruptcy rate was lower than for listed corporations. Josh and Peter have a very nice section where they look at alternatives. So finance through friends and families is one. That's angel finance. That clearly plays a very important role. Unfortunately, we don't know too much about it because there are no filings and so forth. But to the extent that we do have evidence, it seems that venture capital does a better job, at least for medium-sized firms. By the time they get past that very early initial stage, venture capital seems to do a better job. Government programs are how Europe has tried to fill this, what is apparent void in these very innovative companies. And they give an example of a €2 billion program, but the problem was that it became politicized in the sense that every region of every country wanted their share of these funds, and they just got eaten up by administrative costs in the end. And there was a story in The Economist a few weeks ago pointing the same kind of thing, that this huge amount of money provided by the governments in Europe, but it doesn't seem to be very successful in terms of actually leading to these things. My own view is that the problem is you need very high-powered incentives. So one of the characteristics of both VC and LBO funds in the US is that the general partners make enormous amounts of money, measured in hundreds of millions and over the years billions. And I think that that's one of the issues in Europe, is that we don't see that kind of acceptance. So people talk about bankers making a lot of money, but in fact bankers don't make very much money compared to these people. And in Europe it's relatively rare to see incomes of 100 million a year. And if you think of head of major corporations like Philips, for example, which is one of the world's leading corporations, they make €1 million, €2 million, those kinds of numbers. And I think one of the things that VCs and LBO funds need is very high-powered incentives. That was what was the problem for the first 30 years after the Second World War. They didn't get good people because they tended not to pay very well when they were closed-end funds. Financial institutions like banks and so on, by and large, don't have a good record in terms of encouraging innovation and so on. Let me turn to another area which I think is very important, which is we tend to focus on the private sector, but there are very important other areas where finance is needed. And I'm going to focus on a few. The environment is one where I think it's really important that financial techniques are used. Health is another one, and financial access is a third. So it used to be that in the environment, the way that the government would intervene would be to simply hand out money. And if they wanted to improve water supplies, for example, they would make a grant and then that would be spent to improve the environment. But some time ago, what was realized was that you wanted to try and do things on an ongoing basis. So under the Clean Air and Water Act in the US, they set up these revolving funds whereby the federal government would give money to local and state governments, and then they had to provide matching funds, and they had to pay back at least a portion of these funds so that you could keep on going and keep using the money many times over. And that's proved a very important innovation. In the 1980s, when the Latin American countries, many of them had huge debt problems, there were a number of NGOs that realized that they could buy up this government debt cheaply and ask for something in return. And one of the things that happened on a number of occasions was debt for nature swaps. So to give you an example, for Bolivia, they bought up, an NGO bought up a lot of the debt, and then in exchange, the government set aside a huge nature reserve, and they got some environmental benefits from that in the long run. Pollution markets, I guess this is a very controversial area about cap and trade, and in the US we've seen that rejected. I guess in Europe it's been much more successful. But those are a way of doing things the most efficient. So if you give people permits and then they can trade them, then the most efficient producers are going to be able to do things, and the worst producers, the ones that pollute most, won't be able to. In New Zealand we had a similar kind of system with fishing quotas, where again they limited the fishing catch, but the way they did it was the most efficient way, by having tradable quotas. So these are all examples where financial techniques and financial markets have enabled things to be done more efficiently in these non-private sector activities. Global health is another area where I think we have tremendous contributions to make. One of the great problems in the world is that the diseases that kill most people are not in rich countries, they're in poor countries, and there isn't much of a market for the drugs that solve them. Now, a very good example is tuberculosis, TB. TB, of course, before the development of antibiotics in the Second World War, was a terrible disease. If you caught it, you basically had a death sentence. It was very like AIDS before we had retroviral drugs. And it was a very unpleasant way to die. It took a long time and it was very painful. When antibiotics came, TB was cured in the developed countries within a few years. But in the developing world, it's still a major killer. It kills about 1.7 million people a year. So it's one of the biggest killers out there. It's about the same as the number that die from AIDS, for example. Now the problem is that there isn't a market. These are poor people that die from it. And if you wanted to develop a new drug, you wouldn't make any money. So they still use drugs from many, many years ago to cure these diseases. Now there are many foundations and governments, though, that want to try and develop drugs to cure these kinds of diseases. And this is an example of a public-private partnership, the Bayer TB Alliance. Bayer did the drug development, and what they did was to make the best of what they had. So there were donors like Gates Foundation, Rockefeller Foundation, and various governments. There were some market revenues too. And what they did was to pool all of those things and form this TB alliance and start developing anti-TB medicines. And this is one example. Andy Lowe has a very nice paper with some co-authors in Nature, which argues that if you can diversify drug expenses, you can do much better than the kind of system we currently have. And I think this is an area which we need to do much more in finance. If we look in in the developing world, Kenya is a very interesting place. They've developed whole sets of new technology. Safaricom, which is a listed subsidiary of Vodafone, developed M-Pesa, which is this mobile payment system, and we don't quite have anything in most Western countries. It's very effective, it's extremely widely used. Equity Bank used computers essentially to bring down the costs of bank accounts to such a degree that they could have very small accounts from very poor people, and have been hugely successful in doing that. And that's an interesting one because they've made money doing it. They're actually the third most valuable company listed on the Kenyan Stock Exchange. And then Acacia is actually a combination of both of those. So finance has tremendous positive things to do. But the problem is that the financial crisis has underlined that there's this dark side. So what we've seen is with the crisis, Ajay did a very good job of laying out the timeline, but there are these enormous externalities that we've seen. And if you do the deviation from trend growth, it's trillions and trillions of dollars. So this is a really important area. The other thing it's shown is that we do have an industry which today has extraordinarily high financial reward. So if you want to be sure of making large amounts of money, the last decade or 2 decades, the easiest way to do that was to go into the financial services industry. If you wanted to be really rich, you had to go be an entrepreneur, like Bill Gates or Steve Jobs or whatever. But the chances of success there are pretty low, and most people don't succeed. But in the financial services industry, if you made it to one of the top institutions, you had a good chance of being very well paid. Now what we've seen though, and this is one of the things that the crisis has revealed, is too many people went and took an illegal view, and I'll talk more about that. Now the problem is that fraud and theft that we've seen so much of has the ability to shut down markets and hamper their operation. And I think the other thing that the financial services industry did very well is they captured politicians, they captured government officials, and they did it in various ways. So we see Wall Street was one of the biggest contributors to both political parties in the US. And we see high-paying jobs being given to officials soon after they retire. So it's done in many ways. It's done in Europe as well. And so what we've ended up with in many cases is a financial structure that benefits the industry at the expense of the public. And I think if you look at the pushback on banking regulation, to give you one example, we had both Christine Lagarde and Mark Carney arguing that there was just too much pushback, and it was hampering very important reforms of the kind that Ajay was referring to. So my time's coming to an end. Real estate booms and busts are very important. There's a lot of evidence that they are what caused crisis. Reinhard Rogoff, a very good example of that, and I recommend that to you. I think one of the things that we tend to do with the current crisis is focus much too much on what happened in the specifics, particularly in the US, but there have been many crises that come quite frequently, and this is a table showing a number of them in recent decades. I think we don't understand real estate prices very well. We were just talking beforehand about London and the incredible prices that you pay there, and of course it's now booming again. It's, they have Mark Carney in the press and saying, we've got to do something about this, and it's very difficult. We don't really understand pricing. So if you look actually at the UK, it's very interesting. They actually had a bigger rise in prices than Spain. And we keep talking about the crazy Spanish bankers that were lending to these markets, but you've got to worry about the British bankers. But it hasn't burst in quite the same way yet. But this is one of the major issues. How do we understand real estate? How do we stop these damaging boom-bust cycles? Let me talk a bit about some of the other really severe problems. It's really staggering the amount of illegal activity that we had. At the beginning, I don't think there was much pursuit of that. But if you think about Madoff, how did Madoff happen? How could we have the SEC going and checking on so many firms, and now somehow they missed what was going on? Madoff, despite the fact people were writing letters to, and so on. And we've got various other ones like Stanford. We've got all the insider trading things. We had the galleon, and now, with the SEC, we've got a lot of convictions of people. They haven't managed to get Steve Cohen on criminal charges, but it seems that a lot of what hedge funds have been doing is trading on insider information of various kinds. The ones that I find the most amazing are the LIBOR and FX scandals. It seemed to be very easy to get 20 people to commit felonies. I mean, fraud is a felony. It's a very serious crime, and yet it was easy. You just bought a bottle of Dom Perignon or steak dinner or whatever, and we'll see how that plays out. But these are extremely damaging to the industry, and I think it's difficult to stress too little how much this affects the way we're viewed, the way we're regulated, and all the kinds of things that will be done going forward by governments against the industry. And my own view is this is really a fight for the spider, because there's a desire in many cases simply to shut down all of these kinds of things that have potential to do very good things. And it's not just illegal. There's this very nice paper in the JFE about structured equity projects, which shows that they were overpriced, they were very complex, ordinary people couldn't figure them out, and yet competition didn't solve the problem. I think most of us would have said, well, that wouldn't be a problem if there's competition, but in fact it was. And this was very widespread. This is an unpublished paper by Dan Bergstresser, but he documents that this was quite widespread. Now I'll end up with one example. I think, one of the best securities in the world is Netherlands public debt. And this is a contract for Netherlands debt. And it's a very simple contract. It's the height of simplicity. They say, we're going to pay you in these dates. This is what you do. And this is the whole contract for a Netherlands public bond. And the Netherlands has a very long history, and I thought it was default free, but I was giving a talk at Erasmus for somebody's inaugural lecture, and one of the economic historians there pointed out to me that no, in fact in 1897, I believe it was, there was a technical default on Dutch debt. And what they did was they went and found the 200 richest people that were holding this debt, and they wrote to them and said, I'm sorry, we're not going to pay you the interest. They paid the interest to everybody else, all the poor people got them. So whether it was a default or a progressive tax is an interesting intellectual question. But this is what we should be aiming. We should aim for simplicity and things which everybody understands and can deal with. So I think we need to eliminate the dark side. We need to make sure that we get the benefits from the bright side. And we need a proper legal, regulatory, and ethical framework for the industry to operate in. And we've done some reforms, but this is just the start. And so on that note, hand over to some of the things the CFE is doing, which I think is extremely important.
Thank you, Frank. We'll now turn to our second panelist, Nitin.
Thanks, Franklin. Good morning, everyone. It's an interesting place in which to reflect on the future of finance. This place was clearly designed for worship. Perhaps today we can serve both God and Mammon at the same time. I'd like to thank Jack, and I'd like to thank FMA as well for inviting me here. I'd like to thank Ajay for a very kind and generous introduction. Contrasted sharply with an introduction I had a few months ago. I was in Prague at a conference, and the moderator said, well, Nitin started his career at Arthur Andersen. He went home to Lehman Brothers. Oh my God, let's hope CFE Institute has better luck. I used to add, what if that happened long after I'd left? So what I'd like to do is just start with a very brief introduction for CFE Institute, the organization that I represent. In case you're not familiar with it, CFA Institute is a global association of investment professionals. Our mission is to lead the investment profession by raising standards of education, of ethics, and professional excellence, ultimately for the benefit of society. Those last few words were added in the wake of the financial crisis to make explicit what was already implicit in the tint of being a profession. Every profession has that obligation. It exists solely for the benefit, ultimate benefit of society, not primarily for the benefit of its members. We do a number of things, of course. Perhaps we're best known for the CFE program, which is a master's level educational program in finance and investment. We have 120,000 members of CFE Institute, whatever, 100,000 of them are CFE charter holders, and I know many of you here are CFE charter holders, or your students are taking the CFE program, the exams as well. We also have university partnerships with 300 of the leading universities around the world, where university programs have embedded at least 70% of the CFE program in its curriculum and its learning outcome statements within their own programs as well. What distinguishes us, perhaps from a typical university degree, is our emphasis on ethics and professional conduct. We aim to be an ethical champion, and I was reminded of the importance of that recently. I was going through Dulles Airport in Washington, D.C. on my way to the headquarters of CFE Institute in Virginia, and the immigration officer asked me, he said, what do you guys do at CFE Institute? And it was a long flight from London. I was a little tired, so I gave him my short answer. I said, well, we try to raise standards of ethics in finance. He slapped down my passport and he said, well, try harder. try much harder. And it's no surprise, the erosion of trust that's taken place due to the recent crisis. Here's a word cloud. It's from a book by John Taft. And the public was asked what they thought of when they thought of finance practitioners and professionals. And here are the words that came to their mind. Corrupt, greedy, crooks. Could they be talking about us in the industry? I'm afraid that they are. And I remember when the certification officer first said, try harder, I thought the young man was rude. But then on reflection, I decided that in fact he was right. We do need to try harder. We need to try harder to earn the trust of investors and consumers of financial products whose trust has been eroded. These investors toil and save and they invest. We need to find better ways to serve them, to share the returns of their investments a little more fairly, to make sure that the risk that they're exposed to is fair. So we do need to try harder. Here's another piece of evidence pointing to the trust deficit as a result of the crisis. This was a survey that we did together with Edelman Investor Trust last year, and we simply asked lots of consumers of finance the degree to which they trust a variety of industries, and financial services came right at the bottom. This is the third year in which financial services is in that special position. I'm hoping that with the onset of the football fever and so on, FIFA will become the new axis of evil and will take our place perhaps. Some more evidence, we did a survey of our members around the world and we asked them which ethical issues were the most serious. And they pointed to market fraud, to integrity of financial reporting, and to disclosure in general, but especially for derivatives as the three most important ethical issues that they face in their work. We asked them also what factor they contributed or they considered led to the recent financial crisis, and they pointed to a lack of ethical culture within financial firms. So a clear erosion of trust and a feeling that finance has lost its way. So in response to all of this, what we did a couple of years ago is we assembled 15 wise men and women around the world to tell us what we should be focusing on to try and repair the damage that's been done. And here are the people that we assembled in our advisory council. You may recognize many of the names and the faces. They include a lot of professors of finance as well, including John Kay. In fact, John was my professor when I was at London Business School half a lifetime ago. We also have Andrew Lowe and so on, Robert Schiller, who won the economics prize, the Nobel Prize very recently. And these people told us that there were many things that needed to be repaired, but there were 6 themes that we should really focus on to ensure that the future of finance was indeed bright. And here are the 6 themes that they led us to. The first one, the importance of putting investors first. It may seem very obvious, but it's paramount. So much of what ails finance is due to a failure to put investors and clients first, and this needs to be repaired. All too often, perhaps individual practitioners put their own self-interest first, the interest of their companies second, and perhaps the interest of the clients last. That order clearly needs to be reversed. Secondly, there's often a lack of sufficient knowledge to make the right investment decisions, not only on the part of the buyer of the investment product, often on the part of the seller as well. But this asymmetry in knowledge needs to be addressed, and also a lack of sufficient knowledge on both sides needs also some attention. Now, part of the reason for the mistrust is also because customers are not always provided with the right information. There simply isn't sufficient disclosure, far too much obfuscation, and what's needed is greater transparency and fairness. The fourth theme is about regulation and enforcement. We need to, as an industry, the industry needs to focus away from trying to capture regulators, as Franklin mentioned, trying to compete too hard. Instead, they should focus on working with regulators to ensure investor protection. Also, regulators need to ensure that they spend enough time on enforcement, not just creating new regulations as well. The fifth theme is about the safeguarding the system and reducing systemic risk. It's clearly a growing issue as finance gets more complex. And finally, retirement security looms as a great problem. In fact, one that can become so big that it could overwhelm us and lead to the next finance, economic and social crisis as well. So these were the 6 themes that our advisory council asked us to focus on. And what I'm going to do is just touch very briefly on each one to give you some indication of what we're trying to do. And we're trying to enlist the support of the industry, of regulators, and also of academia for each one of these. So starting with bring investors first, we put together a statement of investor rights to try and redress that imbalance in power and knowledge that I mentioned earlier. So this statement of investor rights was developed to advise buyers of financial service products of the conduct that they're entitled to expect from financial service providers. Things like independent and honest advice. They all reflect the fundamental ethical principles that are critical to achieving confidence and trust in any professional relationship. Now, we suggest that providing investors with such a statement would empower them and put them at ease. We would also provide a benchmark for what they should expect and what they should ask for from their professional advisors. Clearly, putting clients first is also a call for greater professionalism amongst practitioners as well. But even with such rights, many investors make financial mistakes because they don't understand finance. Ignorance, bad advice, and poor judgment all interact all too often to lead to financial mistakes and poor decisions. Finance is, as we know, finance is complicated. It's full of jargon. Can the average investor really make an informed decision? And here's the challenge, and the reason for our second theme, which focuses on financial knowledge. This was a survey done some years ago, and some very simple questions were asked. I'm sure you've seen versions of this. Some simple questions were asked of the lay public. The first one said, if the chance of getting a disease is 10%, how many people out of 1,000 will be expected to get the disease? Well, most people got that right. They could work out 1/10 of 1,000, but not everyone got it right. Second question, if 5 people win the lottery and the prize is $2 million, and if that lottery prize was to be shared equally amongst the 5 people, what would each one of them get? In other words, a simple division of $2 million by 5. And only about half of the people got that right. The third question, a little more complicated, where you put $200 in a savings account, then it's earn interest at 10% for a couple of years. What would the balance be? So compounding interest over 2 years. Not trivial, but not that difficult either. And yet only 1 in 6 people got that right. Most people simply aren't equipped with basic maths, let alone understanding of finance, to make the very important financial decisions that they need to make. So after we've stopped weeping, perhaps, what should we make of these results, and what should we do? While emphasis on financial literacy for the lay public are laudable, and in fact we spend quite a bit of effort and resources in trying to do that, I think we just need to admit the reality that the average consumer of financial products can only do so much. That places a much greater burden on those who sell financial products. I think we need to make sure that they're properly equipped with knowledge and with the right ethical conduct to help the average consumer of financial products as well. And yet, the industry, or the profession, barely exists as a profession, even though that's part of our mission. There's no professional requirement, for example, in most jurisdictions to manage money. And yet, you or I would barely think of going to a doctor if she didn't have the appropriate qualifications, if she wasn't current in her practice, or if she didn't abide by some code of ethics. And yet, we readily trust so much of what we've said to people who don't abide by any of those criteria. So I think what's good for healthcare should be applied to healthcare as well. We need to professionalize the industry in the same way that medicine was professionalized well over a century ago, and the legal services were professionalized as well. We may also need to think a lot more about what we teach students and young investing professionals. Perhaps we need a much broader curriculum that includes history of finance, behavioral finance, and ethical conduct as well. And that's what we aim to do in the CFA program. So my 20-second plug here with a couple of slides. Here is a CFA charter holder who said that she took the charter, she took the exams and got the charter because she wanted a globally recognized qualification that not only focuses on improving her competence, but also her character as well by teaching ethics. And employers have become wise to what the attractions of the CFA program are. And here, the growing number of CFA program candidates, most of them are underwritten by their employers. And you can see the steady progression. You can barely tell that there's been a financial crisis in the last few years if you have to go by this chart. Then we move on to the third of the 6 themes, which is about disclosure. And these two charts try to summarize the general lack of disclosure that's the norm in the financial industry. The one on the left-hand side, where the cost of investing rarely understood in their totality. Often the management fees and some of the others are evident, but so much lies below the surface, just as it does for an iceberg. The chart on the right-hand side, again, somewhat dated, but I think it's still true. The question was asked by Fitch Ratings about key disclosures in financial statements, and you can see how many of the most important items are actually missing from many financial statements. So we need to do better. And it was US Supreme Court Justice Ms. Brandeis who once said that sunlight is perhaps the best disinfectant, referring to the benefit of openness and transparency. So as a minimum, what we need are some standards for investment reporting to prospects and clients, and that's what we're trying to aim for. We were surprised when we started this study that in fact there were no established principles for reporting to clients, either the investment strategy or the investment results. So we decided to establish those principles, and this is very much a first step in that direction. All of these bullet points that I've listed here, I'm sure if you will agree, they seem so obvious, but it was important to actually establish those principles and try to lead the industry and the profession towards understanding them, recognizing them, and to practicing them as well. Moving on to the fourth of our themes about safeguarding the system and systemic risk. Here's a question that was asked by Oliver Wyman, a major consultant for pension funds, and they asked consumers if they were nervous about committing to savings for the long term, why was that? And more than half of them said it was because of financial industry failures. In other words, risk and systemic risk matters a great deal. It seems that greater integration and interdependence of financial markets increases the fragility of the whole system, and reducing this risk is critical to allaying investors' fears. Regulators understand this, and of course they're busy compiling new rules, forcing more capital, central clearing, and other defenses as well. But it's not just banking, shadow banking that's come under regulator scrutiny. More recently, the fund industry has also got a lot more attention from regulators, with a focus on redemption risk, on leverage risk, guarantee risk, earning risks, and so many others as well. So in response to the need to try and mitigate the systemic risk on a structured basis, we assembled another group of people in the US this time, and we call it the Systemic Risk Council. Among its members are Paul Volcker, Sheila Bair, William Donaldson, and Jeremy Grantham. And their goal is to ensure a financial system in which we can all have much greater confidence. So it's a work in progress. We're working with regulators to provide our views, both that group's views, but also our 100,000 plus members around the world, their views on how systemic risk can be mitigated. The fifth theme is about regulation and enforcement. This chart shows the blizzard of recent regulations, especially in Europe. It shouldn't surprise us that politicians and regulators have been given a new mandate to provide safety through more rules as a result of the financial crisis. But the industry reaction, as Franklin mentioned and I mentioned, has been to lobby against all of this. And as an antidote, perhaps we should first remind ourselves that regulation has a reason, that good regulation provides for efficient capital allocation. It provides consumer protection, and it mitigates against the systemic risk that I spoke about. And some of the negative responses already mentioned, including lobbying and regulatory capture and innovation to avoid regulation, just aren't appropriate in the wake of the financial crisis. We also should complement good formal regulation with self-regulation. And I know self-regulation has attracted a lot of criticism during the financial crisis. Some of it, perhaps a lot of it, failed, but I think we should also make sure that formal regulation can't possibly regulate all the parts of the industry and the work that practitioners do, it has to be complemented by self-regulation. And any profession is an important part of that network of self-regulation as well. And ultimately, good regulation raises confidence in the system, it encourages greater investment as well. The final theme that I mentioned in the list is about retirement security. Here's a chart that summarizes the problem. We're all familiar with it, of course. This is from The Economist, and it's the old age dependency ratio, number of beneficiaries versus number of workers. And look at the trend from the 1950s, projecting forward a century later to within a few decades. The 2-to-1 ratio that's projected for 2050 is clearly unsustainable. So what's the solution? Well, we've just put together some essentials of a more secure retirement. It's really an exhortation to the average worker to do the right things. First of all, to get started. In getting started, the first basic rule for saving anything, you have to spend less than you earn. You have to open the same saving account as well. And then to get into the habit of that saving, to keep it going, and then to invest wisely in a number of ways as well. The Financial Times late last year listed a number of things that we need to do to tackle the pension crisis. We need to work longer, to start saving earlier, to save more, and so on. None of these are new. We've all heard them before. We know we need to do all of these things. So the challenge isn't that policymakers don't know what to do, it's how do we get it done? And perhaps here's the real challenge, the political one. This is Jean-Claude Juncker from Luxembourg saying, we all know what to do, we just don't know how to get elected after we've done it. And that's why we should stop lobbying regulators to stop regulation. Instead, we should probably be lobbying politicians to make sure that there are better savings plans around, that there's the right regulation to protect investors as well. Okay, let me conclude here. The recent financial crisis clearly revealed serious flaws that have developed in the culture of finance. Perhaps the pendulum swung too far, with too great an emphasis on profits and not enough on professionalism. Perhaps a swing towards innovation and entrepreneurship and away from integrity. Perhaps also too much of a focus on the parts of investment practitioners on building their career instead of building their character. In other words, a swing in favor of business success and away from professional values. But that tension between professional and commercial interests has always been there. There's a quote from Adam Smith, writing over 200 years ago, who said, "Managers of other people's money rarely watch over it with the same anxious vigilance with which they watch over their own. They very easily give themselves a dispensation," he said. Well, as professionals, investment practitioners, that's what we must avoid. We need to work harder to regain the public trust that's been eroded, the wealth and welfare of our society invests upon it. And yet it seems a daunting task. How can any of us, as mere individuals, possibly restore the trust of a whole community and a whole society? And here I'm reminded of something that great leader Mahatma Gandhi once said. He said, if you want to change the world, then you must begin with yourself. You must become the change that you wish to see in the world. In other words, each one of us has the responsibility to restore society's trust in finance, whether you're an investment professional, an industry practitioner, or an academic professor. It really does start with all of us. And how we meet that challenge will determine our success in the long run. So the future of finance starts with all of us, and the future of finance depends on what we do. So let me conclude there and get ready for Q&A. Thank you.
So we're now going to open it up to you, the audience. We have a mic here, so
much of the discussion is for
So much of the last discussion especially was taking the perspective of the individual as the ultimate investor. But what many people discovered to their great sorrow was that there is another investor in a lot of this, and that is the taxpayers. Not just with too big to bail banks, but also with residential real estate, at least in the United States, with the housing GSEs, with student loans, with small business loans, and a variety of other programs that are ultimately being guaranteed by the taxpayers. And here it's not just the financial services industry that's pushing to expose the investor, the taxpayers to greater risk, but it's also the industries that benefit, such as the builders and developers of real estate, the agents that help sell properties, and the borrowers. So how do we protect the taxpayers' interests when they're only sort of paying attention and people who are really paying careful attention and demanding are pushing for the taxpayers to be taking more risk?
So I think there are many dimensions in which we need to react. So I think the law is one very important aspect that we need to make clear that there are certain things that are legal and illegal. And if you look back at what happened in the 1930s, they did a very good job, I think, after the Great Depression to do that, to introduce laws that made it clear that there were certain ways that you shouldn't behave. I think regulation has a part to play, clearly in this case, to protect taxpayers. Regulators need to be very good, vigilant, and we need to have a good regulatory framework, and one that's well thought out. I think we're still working on that, but as academics and Federal Reserve officials, we all have a role to play there. And then I think the other big important part is the ethical part, which Nitin was talking about, creating in everybody the notion that we have to behave professionally and not take our own personal advantage as the primary motivator.
The taxpayers are the same citizens who are mostly consumers of finance, and there's a huge overlap between the two. In fact, the average citizen ends up paying out of two pockets when a financial crisis happens. And the best way to address the risks that the taxpayer faces is by making sure that we avoid financial crises to the extent that we can, and if there is a crisis, that the costs of that crisis are apportioned appropriately and not borne by the taxpayers. So I think ultimately if we all work to improve what finance does and how it does it, that helps consumers of finance who are also the taxpayers as well.
Hello, I have a follow-up question on that. Actually, both panelists stressed on the importance of monitoring banks and regulators. My question is, do you think that regulators in general do have enough resources, both in human capital and physical resources, to monitor banks? And if not, who should pay for these additional resources to monitor banks? Thank you.
I don't think the regulators in aggregate have anywhere near the resources that they really need. Finance is just becoming so large, so pervasive, so complex that good regulation requires a lot more. And as I mentioned earlier, I think the lobbying by the industry should be aimed at politicians to resource regulators better rather than focusing on lobbying excessively to stop regulation which protects investors. So I think they're missing resources and they need a lot more.
So I think probably the regulatory bodies are underfunded, but I think that there's an even more important problem, which is I think governments and regulators were not blameless in the crisis, but they've done an extremely good job of placing the blame on the private sector that there are these greedy bankers in Wall Street and all these other people. And I think you have to ask, why is it that real estate prices went through this boom, and did public actions have anything to do with that? And I think that they did in a wide range of ways, from policies to which were very well motivated to provide housing for poor people. Subprime mortgages had the good aspect that people who couldn't otherwise own houses were able to, and for the first few years that was very beneficial. But in the long run, it probably was quite misguided policy. I think if you look, are low interest rates a good idea? That's a very interesting question. We see possibly many distortions in asset prices, which, when they're correct, have the problem of creating crises. And that's my view of what happened with property prices. Interest rates, credit had a big part to play, but that was part of what the official sector did. So I think it's not just a question of providing regulators with funds. We need to have a much better system of checks and balances within the public sector to make sure that we try and avoid these things going forward.
Franklin, you talked a little bit about the environmental issues. Within that context, if you take catastrophic events, say a 10-degree rise in temperature, albeit events that have low probability, do we know how to price these events and how to actually model those and incorporate that into a financial decision making?
So if I understood the question correctly, how do you price on catastrophic risks, such as a rising temperature, for example, or climate risks and so on? Having been a practicing analyst and a money manager for many years, I think in general we do this badly. I think most analysts, when they look at valuation, all too often ignore the externalities that may matter very significantly over the long term. And I think we're probably at the beginning, in the early stages of understanding all of this as well. Now, for the CFA program curriculum, I know that we've identified this as a gap. Just a few weeks ago, we met with a number of leading proponents of investors who take an ESG approach, a focus on environmental, social governance kind of factors. We need to understand some of these big externalities and the consequences for them. And by understanding them in the valuation, perhaps we'll be in a better position to address these risks as well. So I think a lot more work needs to be done in that area.
I think we as academics have a big role to play here, because I think if you look at financial markets in general, they don't do a very good job of pricing these kinds of low probability but high impact events. So the classic example, I think, from the last crisis is the fact that Greek sovereign debt had a 20 basis point spread over German government debt. And that clearly was certainly ex post crazy, since they actually did default and lost 75% of the value. But also ex ante. And one of the interesting things this week is that Spanish 10-year debt now has a lower yield than US debt. Now, I know we have lots of problems in the US, and over the last 6 months we've seen the issues about the debt ceiling and so on, but it seems very unlikely to me that actually those prices are reflecting true valuations. And I think what they actually are reflecting is the fact that there are regulations like zero weight on sovereign debt even today in the Eurozone, despite the fact we've had recent default in Greece. And so the banks can understand how regulations and how monetary policies like OMT affect prices, because these kinds of calculations are very difficult, and it seems that there are enough distortions in the market that the prices that come up don't really reflect true values, they don't reflect fundamentals. And the problem is that ordinary people, Nitin was putting up the very simple ones of 10% for 2 years, what you end up with 18% get it right. But how do you expect ordinary people to make a judgment about whether Spanish sovereign debt actually is a safe investment or not? That's an incredibly difficult thing to do. And I think these kinds of pricing things are very difficult, and we as academics have a lot to play.
Jack?
I have a question. I just wanted to make sure you were finished. It's actually a question for Nitin. In terms of the practical steps that CFA Institute are taking to try to achieve some of these goals that you've got up on the slide here, could you expand?
Mark, thanks for reminding me of a coffee. Mark asked me that question before I could answer it. I was called away to come here. So Mark's question was, great themes, but what are you actually doing about it? What's practical about it? And what we're doing is we're trying to create some tools, some of which I mentioned, that may actually lead to best behavior. We're also creating forums and events where we invite some of the leading voices on the topic to debate. We're also engaging with regulators, policymakers, and the industry to try and change sufficiently to address the issues that we've raised. And we also exhort faculty, finance professors from around the world to perhaps pay more attention to the ethics of finance and also the sociology of finance as well. And we're hoping that through an approach, creating a mosaic of things that we do, that will make a difference.
Thanks for the thoughtful discussion. It definitely helped get us all think about finance and try to be part of shaping the futures. And from the talk, I think we know that yes, financial innovation actually benefits the society a lot, and we actually see more and more like the other question asking about valuing something that it's previously never think of actually able to put a valuation on it. But this kind of complexity of valuation model coming to the market, it actually creates a lot of questions, because even the most basic asset pricing, like something we all know of, like stock or bond, there's still a question about how much we can actually put in the trust of the valuation put in the market. But now we're actually coming into a lot of new domain, trying to price all this, something we always think is impossible to value. So my question is that, what is the drive all behind this? Because are we really able to value this impossible to value? Can we actually, so where is the stop of like finance cannot put a value on certain things? And the related question is about the simplicity. How can we achieve simplicity given all this demand of complex valuation demand? And what is the drive behind these two trade-offs? And who will prevail in terms of the evolution of the system? And by now, I think I can see it will getting more and more complex. And we have to teach students more and more complex skill rather than the simple way of doing things. It always says it's not enough for you. You actually have to do more. Sorry for the long questions.
So let me just say a few things on that. So I think one of the principles that we don't teach nearly enough, and this gets the financial education kinds of things, is if you don't understand what it is you're buying and how it works, then don't buy it. And that's a cardinal principle, and we don't stress that nearly enough. And so you get these situations like these structured equity projects that Henderson and Pearson document, where they were clearly just ripping people off, and the people thought they were buying something sophisticated and they felt good about that, but in fact they didn't really understand what they were buying. You know, there are some of the other interesting ones. It's not just retail investors. If you go back and you look at some of the scandals from the 1990s, what you find is that even professional investors would buy, or corporate treasurers would buy bankers' trust products that had clauses in them which ended up losing them enormous amounts of money because they didn't realize that if interest rates went the wrong way, then they would end up on the wrong side of the deal. And so this is a big problem. So this is why I think simple things are where we have to start. And given the kinds of limitations that these surveys are showing, probably we should stick with simple things. And these securities which just say we're going to pay you this, and at this date come to these places and so on. These are the kinds of things we need to go back to. That the complexity is a way of cheating people to a large extent. And now, having said that, the evaluation question is very, very difficult. So maybe we have to try and train people who value things to do complicated things, but that's rather different than selling complicated things, I think.
It's an important topic, isn't it? How do you allow innovation so that it does some good, and how do you refrain from being used by the darker side, perhaps, of the future? A number of things, perhaps, that can be done. An emphasis on transparency, disclosure, on adequate financial knowledge on the side of the buyer and the seller, may mitigate some of the risks from financial innovation that's primarily designed to enrich the seller. Also, I think sufficient regulation and sanctions for mis-selling as well, so that there's always the fear that if the innovation is primarily to enrich the seller and not the buyer, not for the benefit of the buyer, that it can result in very severe sanctions and fees as well. I think that would be a part of the discipline to make sure that the balance needed for financial innovation is the appropriate one. In terms of simplicity, I think, again, the point I made earlier, with the growing complexity of finances, we learn more and more how to apply it to real problems. I think the obligation to keep the features as simple as possible from the consumer side, I think it's worth repeating. Again, an obvious point, but one that we're used to all the time. When I get into my car, I really think about the huge amount of complexity and understanding that's needed to actually build the car, and all the innovations that have led to making a very simple car function. All I know is that there are a couple of pedals, one for the gas, one for the brake, and the steering wheel, and that's pretty much all I need to know. So perhaps we should learn from a lot of other industries how to harness a lot of complexity and innovation ultimately for the benefits of even an average consumer.
Well, I have a question on the side effects of the regulations that you mentioned. Well, for instance, now the derivatives market is moving to central clearing, but we know that there are 1 or 2 huge clearing houses, and nobody knows what will happen if one of these clearing houses is going to fail, or due to the capital requirements of the banks, we have huge tightening of lending to small and medium enterprises in Europe, which lead to recent extraordinary policy measures, for instance, the negative interest rates. So we have at one hand the regulations, but we have certain side effects. My question is it possible to avoid the side effects of the regulations, or are regulators, while having one side of the system, they are distorting the other sides and leading, for instance, to shadow banking instead of the regulated banking system. So is it possible to avoid side effects with the regulations?
So, clearly regulation is an extremely complex thing to do, and I think we haven't done a good job of doing it for some of the reasons that you're pointing to. And I think this gets back to the earlier question about enough resources out there. And I think we have to accept that probably we're going to need to put some more resources into first of all, thinking about finance. So, if you look at many universities in Europe, they don't really teach very much finance. And seems true in Asia and the US, we have a longer history of teaching finance, but it's a very important aspect that people start thinking about these topics, doing research on them, and we have a lot to contribute there. The question about finance for small and medium-sized enterprise, very good example. It's an interesting question whether it's a demand-side problem or supply-side problem. It's the ECB and most of the European central banks seem to think it's very much a supply-side problem, but it's not at all clear that it isn't a demand-side problem as well. The people who actually can use the credit properly maybe don't actually want to borrow. If you look at large corporations, they're stockpiling cash. They don't seem to want to invest. Maybe the good small companies don't. These are all very difficult problems which we need to think through and think very carefully about. And this is what the role of academics should be in that.
You ask an important question, how efficient can regulation be in an attempt to regulate? Is risk simply being pushed into different places? You mentioned concentration risks, they certainly exist. What's the right balance between wanting to exploit economies of scale so that they can be passed on to consumers and the systemic risk that concentration creates? That's just one aspect, and the balance to be considered. And the others you mentioned as well are all very real. Just like anytime we make roads safer, drivers drive faster, so the number of fatalities on roads seems to strangely stay constant no matter how much we focus on it. So is that what might happen to regulatory risk as well? These are all, I think, open questions that we need to collectively debate and reflect on. I think finance faculties can better help to understand the true challenge that regulators face, and perhaps we can learn from other disciplines such as systems engineering, other scientists who are looking at biological systems, where the systems that are being regulated are hugely complex, and yet we know that biological systems have been successful given the nature of evolution, the fact that we're here, that there's certainly an approach that can work even in highly complex systems. So, what are the principles that we can derive from that discipline? Similarly, in a systems engineering context, again, the attempt is to regulate ever more complexity, and there have been many principles that have been established by scientists in that area. Perhaps we need to learn much more about them in finance and apply them to regulating finance as well.
Hi, I have an alternative question. What do you think about cryptocurrencies like bitcoins? Do you think they have a place in the future of finance? Do you think they can maybe address some of the problems you mentioned? Any thoughts? Thank you.
I guess my view of Bitcoin and similar kinds of things is they're just money laundering devices. These are ways of people hiding the transactions that they're making that are basically illegal. And so I'm not surprised that in a number of countries there are regulatory moves to outlaw them. You also have the problem, it seems like, that there's been some of these issues of people being cheated and so on with the bankruptcy of the exchange and so on. So I think
Bitcoin is just, yes, one more example of how some people have decided to settle their trade effectively. For a long time, when money couldn't pass between the East and the West because of the Iron Curtain, barter was a very normal form of exchange. There are lots of other ways, IOUs, just trust, just based on people's work. Lots and lots of ways of settling Bitcoin is just one thing. It's ultimately up to the users of that currency or that method as to how much they trust it. I'm sure we'll get a lot more experimentation.
Well, that brings us to the end of the session, so please join me in thanking Nitin and Franklin